Today, Jake Moilanen and I sat down for a rapid-fire discussion about the economy, cryptocurrency, the future of a US digital dollar, hyperinflation, demonetization, and more. We also touched on his trading strategies, seek and destroy algorithms, and finding good signals amongst the noise. After this conversation, Jake agreed that we probably could have dug in much further, so I'll try to get him back on again. But for now, please enjoy my chat with Jake Moilanen. Hello and welcome to the RSnake Show. Today I have Jake Moilanen. How are you, sir?
I'm doing great. How are you doing?
Thank you. I'm doing great. So you and I have kind of a short-lived professional friendship here, but we started talking because we were thinking about potentially working with some internet telemetry for the purposes of doing trading, like stock trading.
Some quant trading.
Yeah. Which was kind of fun because I had this this big mass of internet telemetry. Wouldn't that be fun if I could make it some way? Could we do something with it? And you were definitely the smartest guy in the room in terms of what you could or couldn't do with it. And so that's kind of how we got started talking.
That's right. Yeah. We started, I mean, that was a few years ago now. But
yeah, a couple of years ago, I guess. Yeah. And so the idea was, just generally speaking, if I could predict that something was related to a company, for instance, a bunch of subdomains or a bunch of domains or whatever, and that was changing over time, maybe I could use that to predict their earnings, and then you could use that to predict whether they're going to go up or down.
That's right. Yeah, the server footprint, the bigger it gets, the more likely that there's a tie to the earnings, then it'd be up.
Yeah.
So yeah, that was a basic idea.
Yeah. So that was a fun little project. We didn't actually end up doing anything with it, but
we tried a lot of experiments.
Yeah,
did a few trades.
Yeah. Did you really?
Yeah.
Oh, good. I didn't know that. I'm not surprised by that because you are kind of like this mad scientist when it comes to trading, which is one of the reasons I've really enjoyed kind of watching you from afar, but still talking all the time, if that makes sense. Because one of the things you also have is a little Slack channel called Red Team Investing. Can you talk about that a little bit?
Yeah. It's just a Slack channel, but it started out with just my friends, and we were trying to figure out how to trade better together and also invest in private market deals, venture capital deals. My background is in venture capital and quant trading, but one of the things I always did whenever I was looking at a deal, I'd have someone in the room tell me all the reasons why I should not do that deal, called the red team. And they were pretty much going to tell me that this is idiotic, Jake, you're an idiot. And if I still wanted to do the deal at the end of it, then I knew it was a good deal. So I want to take that same concept, but kind of build a place for my friends to go do it with me. And so that's when I created Red Team Investing, which is a Slack channel. And we do it for public market, where we think the economy is going, where we think, if we see a private deal, we'll go and discuss it. So we've used it for a lot of things, especially crypto as well.
Mm-hmm. Yeah. Although it seems like one of the things you focus on very heavily is the E-mini, the ES.
Yeah, S&P Future. Yeah.
Yeah. So can you explain a little bit how that works? Like the way you first told me, it's sort of like waves of the ocean. Can you kind of explain what that means or how you think about it?
Yeah, absolutely. So so I use the S&P Futures a lot to help dictate where I think the market is going. And pretty much when I look at anything, I kind of look at things in different forms. So I look at it from like the long form, which might be, is a Fed dovish or hawkish? And that kind of think of it like if you think of the waves in an ocean, is the tide going in or is it going out? And the beach is, say, the price of that stock or the market. And the further up the beach it is, the higher the price. The lower down the beach it is, the lower the price. So when the tide comes in, the Fed's, reducing interest rates, then you start seeing a rising tide lifting everything up, and the beach everything goes higher. Now within that tide, you also have waves, and so you have a wave coming in, which that might be that just a normal kind of move, and then it goes out. And so what you're trying to do is even within those waves, you have these small ripples, call it, that where stocks move, small amount, and you can do like scalp trading. But with the S&P, what I really do is I use that to help figure out where do I think the larger market's going, and then what stocks have high correlation with the market. And I know if, say, for instance, it is at some stock is say 80% correlated with the S&P 500, and I know the S&P 500 is kind of hitting that point when it's starting to start coming back, well, there's a good reason why I should probably start looking to exit that position. And yeah, so I use it all the time, and actually I use it this morning was probably a really good example. I knew looking at the option market data that for gamma rebalancing, gamma just whenever a stock moves, they have to rebalance rebalance based off of the option exposure the market makers do. And I knew that pretty much around 3,900 on the S&P futures is kind of where it's going to peak out, and it's going to have a very high chance of pulling back at that point.
And you know that because there's a lot of sell options.
A lot of if you look at the overall landscape of the gamma profile of the S&P 500, you saw what we call a call wall, which is pretty much kind of the limit of like when it's gonna be really tough for it to go much higher. And so I knew that once it got to about 3,900, that it's time to pretty much start exiting positions or at least taking a bunch of profits. And sure enough, today it ended up hitting 38,950. So it pretty much just shy of 3,900, which is pretty much exactly what we expected. But I use that all the time as kind of like the baseline of like where things are going, and I use it to help trade around to understand my risk level for any individual option or individual stock as well.
It's sort of like a war. It's like a battlefield of a bunch of people fighting in one direction, a bunch of people fighting in another direction. And if you have big holes, obviously the opposing troops are going to get through, kind of thing. And
absolutely, it's the bulls and the bears, and there's like these the support levels where you think it can go down to, and then which is kind of like the line that the bulls are trying to hold, and then there's the resistant part where the bears are saying, okay, we don't want that going any higher. And once you finally break a line, there's a good chance that it's going to go to that next level. And so you're trying to figure out what those levels are, and then pretty much say, okay, if it breaks that level, now it's time to start to go long or to buy, or vice versa. If it's a support level going down, it's time to get out or to go short.
I found that very interesting because you could almost watch. It's almost like a ball bouncing between like the old game of Pong or something. Where it's
it really is, yeah.
But the bigger your paddle, the more likely you are to be able to hit it back, kind of thing.
That's right. The bears, for instance, if you break a resistance level, they're like, okay, let's go regroup at that next level, and we're gonna make a stand there. And so that most likely that stock is gonna go up to that next level at least, or pretty close to it, before you start seeing any major pushback.
I've been meaning to ask you this question a while now. Are there people who focus exclusively on just selling? They don't want to be ever in a situation where they're the bull side. They just want to sell.
Oh yeah, there's shorts. Yeah. There's lots of bears out there, and it's tougher because the market's generally long and going up. So to be a bear, you pretty much have to be very tactical and get in and out. And it is very risky because if it goes against you, you have unlimited losses. You can lose, forever. So
short squeeze,
and that's why you see a short squeeze is like, okay, I know I'm losing, so now I gotta get out of this position before I take a massive loss.
So okay, are we in a recession?
Great question. I don't have the answer for sure, but from the classical definition, yes, we are. The classical definition is 2 quarters where negative GDP growth.
So we had negative 1.6 in Q1 and negative 0.6 in Q2, according to BEA.gov, which is, hopefully a reliable position to get this type of information.
Yeah. So we are, from that definition, we are now, there's that classic definition, but then there's also the definition, is this a broad-based economic downturn? And I wouldn't say what we're seeing yet is a broad-based downturn. So I think
when you mean broad-based, you mean global.
You're seeing across all different sectors. You're seeing everyone pretty much being hit by it.
Well, I was just curious, like, is this really a recession? Are we actually? Because it seems, for whatever reason, it seems like Washington would like to make this a very political issue instead of just we're in a recession, and time to get out of it. This is something that's happening, and here's the steps we need to make to move past this point. It seems like everyone's fighting the definition of it instead of just saying yes or no, or so is this one of those things we're going to have to redefine everything we're in at any given time depending on the political climate, or are we in a recession? A
lot of people are trying to redefine what a recession is right now. Biden, I forget what he called it, but it's he definitely is calling it it's not a recession. Powell is starting to admit that maybe it is that maybe we are starting to see some softness, that the inflation is not transitory. But if you look at Powell, he was in a real tough spot where he was trying to. So taking a step back, inflation is self-fulfilling, so it's reflexive. So as more people believe that there's going to be inflation, more likely it's actually to actually occur. And so where Powell was in this tough spot where he's like, okay, we also have this reserve. I think that the U.S. dollar is a reserve currency. So how do I make sure we protect that the U.S. dollar is still our reserve currency and that inflation doesn't hit it too bad because people are going to start going away? And we also don't want to say that there's inflation here because it's going to start being self-fulfilling. So he's trying to walk this line of saying that it's transitory, which we all knew it wasn't transitory. There's no way this was transitory. Yet that was the narrative him and pretty much everyone on the Fed was kind of was saying. And we effectively this is exactly where we expected things to go. And it was a tough downturn. One of the things is when you start injecting that much capital into the system, there's a good chance that that inflation is going to pop up, which is what we're actually seeing.
So we also saw a massive nosedive in valuations right around the exact same time. I was curious, did you see that coming? Did you expect that to occur?
Oh, absolutely. Yeah. I remember, so I'm in venture capital, and I remember telling a lot of my companies last December, you need to be raising now, even though it's not a great time. Start raising now because there's going to be a lot of softness coming. And so yeah, it was pretty obvious. And if you just look at it,
which seems like a good thing because now you get everything on the cheap, right?
Yeah, that is a nice thing. But if you look at it, most valuations of companies are done through what we call a DCF model, or discounted cash flow model. And all that does is look at how much money they're going to make in the future, then discount it a certain amount to get to what the value of that company is. And part of that discounting measure is what is the risk-free rate, or how much what is effectively how much the interest rates that the Fed are charging. And as that goes up, well, that means your discount rate goes up, which means that your the valuation has to come down. And so we knew that when interest rates started popping up, that valuations had nowhere to go but down, just based off of that method of actually valuing companies.
Gotcha. So I want to know what you think about hyperinflation. Is this something we should expect? I mean, we're seeing a lot of inflation. And to give some context for why I'm thinking this, if you go to the dollar store, it's not like it's 5-7% more than it was before. It's 25% more. They raised the rates for the dollar store to $1.25. You go eat meat at a restaurant or whatever, it's much more expensive. It's not 7% more expensive. Rates across many different industries are 20-30%, not 7%, as is stated by various inflation rates. So maybe inflation hasn't reached the different sectors yet, or maybe it never will. But I'd like to hear you say whether you think this is in hyperinflation, or we're pre-hyperinflation, or you don't expect that to happen at all and it'll just stop. Or
yeah, I don't think we're at any real risk of having hyperinflation. Hyperinflation is characterized of between 40 and 50% inflation, which we're nowhere near, and I don't anticipate that we would ever get to that level at least in the U.S. So that's not something I'm terribly concerned about. And I believe as we start seeing the energy prices come down, as we start seeing the supply chain alleviate, we're going to start seeing inflation coming back to the lower levels.
So you believe that's going to happen? You think
we've already started seeing a slowdown in inflation? So it is at least it's decelerating at this point.
Mm-hmm. Okay, so I had never heard this term until fairly recently, maybe a couple of years ago, the term demonetization. So I thought this was actually a very clever thing. So let me get a little backstory on this. So I went back and did some research. 1851 was the first time I'm aware of it happened in the United States with stamp demonetization. Basically, they said anything between these dates, we're not going to accept those stamps anymore. So it's basically like the government doesn't have to risk having this liability hanging out there or whatever. But then it especially came to head in 1861 due to the American Civil War. Obviously, you don't want to have to pay the bill of a person on the opposing side. So any stamps issued before this date, we're not going to accept. You had to have bought it between now and, when the war started, because it has to come from our side or whatever. So that kind of makes sense. It's the country fracturing in half. In 1943, Anne Frank wrote in her diary that the 500 and 1,000 guilder notes were no longer accepted. And that was largely to make sure that they knew where all the secret money was hiding out. So you could take it to the bank and you say, well, I've got all these 1,000 guilder notes. It's like, okay, well, where did you get this? Show me proof that you actually earned this money and why you have it in your possession. So that was a way to kind of out people who might be doing things against the Nazi party. In 2016, Modi in India, so this is the first time I had heard of it, they outlawed the 500 and 1,000 rupee note, which was 86% of all cash in the country. Which that's insane. I mean, that's like 3/4 of the bill in your pocket or more suddenly not being worth anything. And they had like a week to go to the bank and explain why they have the money and convert it into banknotes that they support there. So if you're a drug dealer or a terrorist or whatever, and you show up with briefcases of money, they're like, hey, where'd you get all this money? And you didn't declare it. And so it's a quick way to get rid of a lot of dark money. And then this is where I really started taking interest in it. So the Bolivar Sobreño, which was the Venezuelan cash, went to the Bolivar. It started at a 100 Bolivar note, and then it went, which was 77% of the nation's cash at the time, to the Bolivar Sobreño, which was basically $100,000 worth. And then they went to the $1 million Bolivar digital, which actually isn't a digital note. And the estimates was something like a $10 trillion deflation, but they also got rid of all those old notes. So anybody who was stuck with these old notes, what are you going to do? It's not worth anything. It's not even worth the paper it's written on. So as a monetary method, what do you feel about that? Is that something, let's say the United States went and did that. Suddenly they said $100 notes are no longer worth anything. You have a week to turn it into the bank.
Yeah, I don't think we're in any real risk of that occurring in the U.S. at least. I do think there is a very strong possibility that the U.S. will adopt a digital currency, and the implications on that, there's a lot. I think that wouldn't be a bad thing. I think one of the nice things about digital currency is it would actually help the Fed do their job more effectively. They can see where money's flowing and get an idea of how bad inflation is, or how bad things are in different aspects of the country much more easily. Now you lose privacy. That's the major downside to it. But I think there's a lot of benefits to it. So I don't think we're actually going to see any the actual hard dollar go away ever.
Even with a digital currency?
I don't think so. I think there will always be a demand for digital currency. I mean, but also think about how many times do you maybe don't have.
You mean physical?
Physical, yeah. Yeah. You don't actually have your phone on you, for instance, and you need to pay with actual real physical currency. I don't think that's going anywhere anytime soon. I mean, I feel bad for the homeless because there's gonna be no way to actually really ever give them anything going forward. I think at some point, but we're at F1 this weekend, and I think it's the first time I actually had physical currency in a very, very long time. So I do think we are moving to that, to the more digital, but I don't think it's going to occur completely where we just completely remove all physical.
I mean, what is the implications for that? I mean, if I am just the average person walking around town and the government's tracking every single thing I'm doing, obviously that's going to end up in the hands of marketers and resellers and anybody who wants to have my data. It's guaranteed it has to be open, right? It's going to be monetizable by anybody.
That's already occurring today. I mean, if you have your credit card and you go and you use that anywhere, as a hedge funds can go buy that data to know what you're actually transacting on. Now they might not be able to get down to the SKU level, but they at least can see that you went to Best Buy and you spent $1,000. That occurs today already. So, and people are monetizing off that today. Now this, there might arguably be more privacy because this is controlled by the government, and they might not allow for people to go sell that data, which, so that there is, they might actually say you might have more privacy because of it. I do think that, that it's going to, I do think it's going to be a good thing. And frankly, if I was going to short any stocks, going over the next 20 years, it's going to be Visa and MasterCard. I think they had a Kodak-like moment when the digital camera came out that pretty much, film pretty much went away. I do think that if the digital currency ever becomes to fruition, that you're not going to really need credit cards anymore. You're not going to have to pay the exorbitant fees that MasterCard and Visa charge. So it would definitely I'd be shorting that long term.
Interesting. And what about the fraud systems that those companies bring along with them?
I think they're going to have to adopt to a more, have to provide value add on top of just being able to transfer money. And actually, one of the things in my venture capital firm we invested in was a company called Simple ID, which does along the same thesis where you could go, you'd say you charge something on your credit card, it goes and pings your phone and it uses your biometric on your phone to identify that's actually you. Now, features like that, I believe, is where MasterCard and Visa are going to have to go to provide extra value on top of just money transfer to be able to charge anything. Otherwise, I think that they just go away.
So how do you get your money back? Because right now we have at least some assurance that the Visa and MasterCards of the world will give us our money back.
Well, and that's probably where, another thing where they actually do play and why you might want to pay a little bit to them is because you would, at least have ability to get money back to some extent.
So the money that would have gone to Visa and MasterCard now go to a centralized company that holds some amount in escrow to pay off people who've been ripped off by adversaries in the middle who are trying to buy TVs from Best Buy or whatever. So Best Buy goes to some company and says, I'll pay $1 million a year as an insurance, let's say. And if anybody has their money stolen by virtue of getting TVs from us that they shouldn't have gotten, we'll pay out the victims or something like that.
Yeah, I think there'll be a lot of new businesses that could pop up from that.
Interesting. So it seems like there is some move to devalue the dollar. So the petrodollar is starting to get a lot more press than in the context of this war in Ukraine to turn into the petroruble, let's say. First of all, your take on that is that something that you think is actually an intentional move by this?
Oh, for sure. Yes. I mean, the CCP is for sure trying to devalue and destabilize the U.S., destabilize U.S. dollar as a reserve currency.
So would you have done that move if you were them? Is that pretty much how you would do it?
I think it's death by a thousand cuts. They're trying to chip away wherever they can, and that's an easy place to kind of go after.
Because one of the things they did, they grabbed 2 to 3 times the amount of strategic gold reserves after the Crimean War, which they handily won. But that signaled to everybody, post hoc, that they assumed that their money wasn't going to be worth very much anywhere else in the world, so they're going to have to trade with something else, or they wanted a lot of strategic reserves. Is having like a lot of gold, 2 to 3 times the amount of gold that they had before, and just less than 10 years before, I mean, is that a good place to start? I mean, how do you future-proof your currency?
Yeah, I don't know for sure, but I would. This might not be a popular opinion, but I don't think gold is going to contain the same type of value and matter as much as it did in the past. I do think that a crypto asset, a digital asset like Bitcoin, will supplant gold at some point. And I think the actual structure, I think it actually makes the most sense is you have the just the way that gold was used for everything was back to it. You weren't actually exchanging gold. You weren't actually handing. If I go to the store, I wasn't going to give you gold. I mean, maybe way back in the day, but dollars were created to go exchange instead, and that was actually the medium of exchange. Well, I think the same way Bitcoin is actually going to be a store of value going forward, and it's going to take away some of the requirements for gold, and you're not going to actually exchange Bitcoin. It's still clumsy. It takes about an hour to settle still. You can't handle that many transactions anyways.
And so it suffers from all kinds of like 51% attacks and all kinds of things.
Correct. There's still lots of issues with it. I think that the magic formula though is you do have Bitcoin as a store of value equivalent to gold, and then to actually go do the medium of exchange is going to be a digital currency of some sort. And I do think that the U.S. dollar is in the best position to be that digital currency, or a digital version of the U.S. dollar is probably the best ways of doing it. A lot of these other crypto coins and tokens, I mean, they're going away. No one really trusts them. Stable coins, no one trusts at all. So you really need to have something like the U.S. dollar, a digital form of that, to really be able to do that well.
I read somewhere that there's as many as 12,000 or more crypto, shit coins that have gone under in just this last year alone, and something much higher than that, like 18,000 total since this whole boom began. I mean, that doesn't signal to me that it is a well-lit ecosystem,
No, absolutely not. Yeah, I do believe that almost all those coins are going to be going away. I think there's only a handful of actual good use cases for a lot of the crypto tokens that are out there so far. I'm sure there'll be more, but I haven't seen a ton.
So why do you think it is a good replacement for cash? It seems like we already have this system. It already works well. I can fulfill anything, at any time. There's no reason I can't transfer money across the world with just my bank and a internet connection. We already have all these features. What does that give us? And frankly, I do have quite a bit of privacy. While it is, yes, possible for some hedge fund to maybe know bits and pieces of my financial history, they only know bits and pieces at best.
You're saying, is it why
is it better for the average consumer? Why do we want to switch to it?
To a digital currency?
Yeah.
They're reduced fees. If you don't have to pay Visa, MasterCard 2.5%, that adds up. Imagine doing even a $500 transaction. That starts adding up over time. So I think that people are going to want to reduce their overhead and their fees that are involved. So I do think that it is more convenient, frankly. If you can just go and tap your phone on to go pay and be purely cashless, it is just frankly more convenient. So I think the convenience is ultimately going to win out at the end of the day. And fees as well.
So why wouldn't the Visa, MasterCards of the world just drop their fees? Just get down to next to zero and then use this ad model or selling their data to supplement.
They make so much more on. Visa's some 400 billion or something. They make so much money on the fees that the revenue would be cut.
Alternative is go out of business, right? So,
well, they're going to have to cut they're going to lose 80% of the revenue if they do, probably more than that. So I think they are pretty much faced that they have to make it work, and they're going to have to find other ways to provide value to justify those fees. And I'm not sure that they're going to be able to.
So it seems like there is some element of the West that would like to crush the US dollar and just get rid of it entirely. But it seems like most of these people are primarily anti-government as opposed to pro-cryptocurrency per se. It's not like they're like, oh, well, the US could be so much better if it were on a digital currency. But it seems like those people, from what I can tell, are not really understanding what they'd lose if they got rid of the US dollar wholesale and supplemented it not with a digital currency of the US dollar, but completely just get rid of the US dollar completely. And now we have just cryptocurrencies in general, like Bitcoin, like Ethereum or whatever.
Yeah, I don't think a lot of those people realize just how much they've benefited from the US dollar being the reserve currency. And how much cheaper their cost of capital actually is. Their interest rates are lower. They can get mortgages easier by the sheer fact that the U.S. dollar is the reserve currency of the world. I think if they actually were from a different part of the world, they might see things very differently. But I think it's a very much a naive way of viewing the world.
So various different governments are now. They're sort of preparing for this future eventuality where everything will be digital. What, if anything, do you think the U.S. isn't ready? Why not just do it today? Why not just build it right this second and start implementing this?
Yeah, the systems, the software, it's going to take a lot of time to ever put in place. I think it's like the Y2K bug. There's a lot of software written out there today that would be very difficult to retrofit and go change. So it could happen. It will probably happen over time, but it's definitely not going to be it's not going to flip over in one day.
And if you had to say approximately timeframes, when do you think that would happen?
I know.
Just guess.
10 years. I don't.
All right. So another couple election cycles, maybe we might start seeing stuff like that, because I think a lot of people see that as either strongly pro or strongly against. And there's very few in the middle who are just going to go, whatever, I'll just deal with whatever happens. Because I think there's such a huge privacy component. And it's hard to have a digital currency that everyone can uniformly agree, this person has this thing in their account or they don't, if it's on a consensus protocol, and then you get into all kinds of other things, and everybody can track it. For instance, it's one thing for me to swipe my credit card and go to a convenience store, and the shop owner has no idea if I have $1,000 in my account or $1 million in my account. They have no idea. So, but if they could just look on the blockchain and say, well, this person has traded like $400 million this week in different commodities or whatever, well, maybe they got some money in their account and, follow me home or whatever.
Yeah, I do think, one basic feature, core feature that why credit cards wouldn't go away is if a digital currency would act like a debit card, where credit card, pretty much you're actually being provide credit. And so you can go over your limit if you need to go pay off something. And you take on more. You can take on debt. So there is a core feature to that. Now, and how many Americans are in credit card debt? So they are definitely making use of it. But I do think that
leverage.
Yeah, exactly.
Yeah. So going into the future, there is always a possibility, and we're already seeing this with China, for instance, with their social credit score, but there is a possibility that governments might utilize this. Everybody has their flavor du jour of whatever government they want to be in control, but when any government gets unchecked, there's all kinds of problems, and having very tight monetary control, whether it be to curb terrorism or, stop child pornography or whatever good original premise they might have, ultimately it leads to them also being able to flip the switch and say, okay, we have political rivals and we needed to go take them out. We saw this happen in Canada, for instance, when the trucking, the trucks basically went into, I think it was Montreal, and locked the entire thing down, and then people were donating money to the families to let them keep on trucking or whatever. And the Canadian regime basically said, no, if you do that, your business account is blocked and you can't trade anymore. Basically, your money is locked up in this bank account. So we know that it can happen, even in the Western world. This isn't like some far off location or something. So what is the average person to think of that? Like, well, do I really want the centralized government, to have that much access over my ability to spend, which even using banks, that's already a bridge too far. And now you're also going to get rid of my cash.
No, I think it's an absolutely fair point. I think it is unlikely. You have three branches of government for a reason. And even from a privacy standpoint, you look at how much the government has gone after Facebook. So I do think they'd be a tougher sell in the U.S., but that's not to say that it couldn't happen. That's why I think the physical dollar is going to remain, for a long time.
And so how would that affect, let's say, the average convenience store or Macy's or your car dealership or whatever? Are they going to just eventually say, screw it, we just don't take cash? Because that's kind of already happening.
That's already happening, yeah. How many times have you gone to like a food truck and they won't accept cash? It's cashless is becoming more and more common.
And under the pandemic, that seemed like that was a jump start to that direction.
It's an acceleration for sure.
I don't want to get too conspiracy theory, but do you think that was part of the plan? Do you think that was something that higher ups were like, actually this kind of helps this long-term game of getting more of this cryptocurrency out and getting people to move to a more cashless society, which we can track. Even if it's not us tracking it, it's a partner, it's Visa, MasterCard, or it's the banks.
I think there's a lot of economic destruction that occurred that was just a benefit for them. They probably wouldn't have put us through that, I don't think, just to I'm not claiming that they created it for that effect, but more like, well, that was, very convenient. Maybe we should double down on that in the future, or, keep people guessing. It's already out there. Why not just to keep them in their household for a little bit while longer and using more and more cashless? And I'm not saying that that's true, but boy, it's awfully convenient, It did work out.
Yeah, it's a little sketchy.
Hey guys, I have a question from the control room.
Yes.
Hey Jake, do you ever see the government, when they set up the United States crypto service, do you think they would basically say, get rid of all the Bitcoins, get rid of everything else, and you can only use the government currency, digital currency? Do you think that's a possibility?
So outlawing all cryptocurrencies except for the US one?
I don't think so. I forget the the entity that monitors the commodities, but both Ethereum and Bitcoin are actually under the purview of that entity now, and so it'd be very difficult to remove those both, just because there's different branches that have to pay attention to it.
Well, a follow-up question would be, we've seen China basically say that they are no longer going to allow cryptocurrencies in the country. It's probably an energy issue, just too many people mining and it's unregulated, whatever. But what they haven't done is say you're not allowed to use currencies, other nations' currencies. But that seems like that would basically just perfectly say you cannot use this U.S. digital currency because it is a digital currency. It is a cryptocurrency.
I mean, yes, they definitely would want to block the U.S. version. My opinion is that the CCP was trying to do surveillance and ultimately control the monetary supply. So I think that was very, very intentional.
So how does the U.S. maintain itself as the premier dominant digital currency amongst a sea of literally tens of thousands of failed digital currencies?
Well, I think this is a much larger question. So how the U.S. maintains the reserve of currencies, I'll start there.
Sure.
Let me take a big step back. So one of the things I always look at is I try assessing things over a larger time frame and then get narrower and narrower. And there's a few models. I'm not a classically trained economist. I pretty much have learned everything I've learned out of necessity. But one of the things that that if you look at it, there's a few books I think are really great models. Ray Dalio just had the Changing World Order book came out, which I thought was fascinating. And this really talked about how nations and empires have risen and fallen over hundreds of years, and what it has done to a lot of the reserve currencies. Mm-hmm. And it's been interesting because you see you look at Rome fell to the French, which fell to British, which fell to the U.S. And then you see how the U.S. is starting to teeter on the point where they're actually starting to lose control. They're starting to become the downfall of the U.S. empire, and that's you start seeing that from like a very populist type government to a lot of social unrest, and then you look at we're likely going to fall to China with China's 2049 plan. That is definitely their angle, and there's a good chance that the U.S. dollar will lose its reserve currency status at some point. Now, within that, those larger, multi, 100 years type time spans, there's this other book called The Fourth Turning, which is all about breaking things down into about 4 generations of time, roughly about 80 years. And you see these generations, these 80-year blocks, follow a very predictable pattern over and over again. And even within that 80-year period, there's roughly about 4 generations, about 20 years each, that occur, and these patterns occur over and over again. A lot of it's just due to the fact that what you are and where you are in society at the time. How do you handle like a turmoil that's occurring, and how you react in the future? As you found that there's a very much a generational type of pattern. So if you look at like right now, we're about to approach the fourth turning. The first turning is effectively started at the end of World War II. And that's when it was a period of just prosperity. That was the time in the world or in the U.S. where we saw most even making roughly about the same. You could work at the gas station, still afford a home. It was a nuclear family type of time. About when JFK was assassinated, you started seeing things shift from that to kind of the awakening, where a lot of individualism started being celebrated, and people trying to kind of discover themselves. And that that was another period of just a lot of prosperity, but that around 1984, when Reagan won the second election, you started flipping over to the third turning, which was effectively when we started seeing things starting to get a little bit a little bit disheveled, a little bit questionable. Started seeing some things like the LA riots. You saw 9/11. You saw the Columbine, and a lot of these stuff started happening, and started shaking up the foundation. And then around 2008, with the big global financial crisis, that's when you started seeing the fourth turning occur, and that's really marks kind of where we are today. And that's when things start going awry. This book was actually written in 1997, and it predicted that we would see somewhere around 2020. It was very eerie that we'd see a pandemic. We'd start seeing wars again, and it punctuates and every single time. But there's a massive war that occurs. If you look 80 years ago, from now, that's when World War II was. 80 years before that was when the Civil War was. 80 years before that is when we saw the Revolutionary War. And that's just the U.S. This pattern has existed across all kinds of nations across, through history. So if you understand where we are, you can start seeing that we are definitely not only are we in the kind of the rising or the falling time of the U.S. empire, but we're also in this fourth turning where you see, a new superpower could be emerging, and also where we are from a generational standpoint could also, lead to our ultimate downfall. So I think that the risk of a reserve currency, we losing that is very, very high right now, just given the fact that these cycles are all lining up at the very wrong time. Now, I think there's something to be said that, that things, if you look at what is actually why a reserve currency actually maintains its hold, it's really, if they're doing the most commerce, most trade with a nation, that's what really dictates if it's going to be a reserve currency or not. China now has more trade than the U.S. does. However, if you look at, I don't remember this exact number, so I'm not sure where I got the source from, but I remember hearing something like 100 million businesses across the world have their accounting system wired to the U.S. dollar. It's going to be very difficult to displace that, in the short run again. And so it's going to keep a lock hold on the U.S. dollar as a reserve currency for a little bit longer. Now, I think if we do go to a digital currency, it makes the most sense to go with the U.S. dollar because it is the current reserve currency, and people will trust it where they might not trust, pick your favorite token out there. But I do think that there's a chance that our reserve currency might last much, much longer. But we'll see. I guess history we'll see if it does repeat again.
Well, that's all terrifying. Follow-up question on that one though. So why do you think it's going to be China? Why China as the next big superpower economically, beyond the obvious that they are growing quickly?
Well, I think the biggest problem the U.S. has is very short term. How we think in election cycles. We do all of pretty much all of our planning based around these very short term type outcomes. Where if you look at China, they've taken in the formation of the CCP was 1949. And they pretty much had this goal, this multi-generational goal that all leaders adhered to actually go and make sure China was a superpower in 2049. And so I think the biggest downfall of the U.S. is it's just too short-sighted, where the CCP has taken this very long-term type of view. And I think it's going to be very difficult for the U.S. to compete with that because we think too short-term.
It's one advantage of an authoritarian government, I suppose. The one negative, though, it's been playing out very interestingly in the Ukrainian conflict is having a centralized control where you have, no one gets to make a decision on the battlefield. It all has to roll up to some, general, and then even that general's, his boss until you finally get the person who says, yes, you can drop a bomb here or whatever. It makes it incredibly difficult for the Russians to function, and everything, their supply chains are very hampered by this and all kinds of stuff. So in one way, economically, maybe it is great. In other ways, militarily, maybe not so great.
That's true.
Interesting. So let's switch back to investing. This was an interesting tangent. I'm glad we went down there. I've been thinking for a while now, this phrase I can't get out of my head. It's like, you're too poor to get rich, which, I realize is not true. I mean, people bring themselves up from nothing all the time, but there are certain things that are standing out more and more to me as being sort of institutional classism, for lack of a better term. And so one of the simplest ways I like to explain this to people who are not in your line of work, so they require a little more explaining, is I'll be like traveling down a road and I have the option. I can travel on the main road or I can go in the toll lane, which in Texas, you just pay for it. It's not like I have, it's not like a carpool lane where I have to have a certain amount of people in there. I just decide I want to go down this road and I pay more and I get there. And so maybe I save a couple of minutes every day, which, time is money. So that's kind of somewhat useful. But also I'm less likely to interact with police officers. I'm less likely to get into a wreck, even a minor wreck, just a little fender bender. That fender bender may not seem like very much, but when you add it up, compounding, like, okay, well, that fender bender is there, but I was maybe not ready to pay for this out-of-pocket expense right then and there. My insurance, it says it's my fault, so I'm kind of in trouble on this one a little bit, or I don't want to tell my insurance about it at all, so I'm going to pay for it. And now the cop sees me with a busted taillight or whatever, and it just starts spiraling, right? This thing just keeps happening. And it all stemmed from me deciding to spend an extra $1 or $2 to go down a different road. And so in this world, there's this whole concept of accredited investors, or people who have enough money in an account to be able to become a pattern day trader. Like what is sort of the minimum amount of money you think it would take to be in your world and actually make money?
Let's separate the type of way of making money. So either have the public market versus the private market. So private market, you need to be accredited to go invest in. That's not to say that accredited investors make any better decisions than the larger population. I can tell you for a fact that in most cases they do not. That they just can handle a massive drawdown, unlike most people. Now, so that's different from on the public market. You definitely need to have, and just to stay in the private market real quick, you need to have. I've done the math on this quite a few times. At minimum 10 private investments. Most likely 20 investments to really be able to realize an expected return that's positive. And the reason for that is if you're doing a private investment, most of the time it's a startup. And the stats are not great. 64.8% of all startups will not return the money back. So it's just that last, call it third, that has the lion's share of the returns. And now the nice thing about that, it's very asymmetrical to what that return profile looks like. So if you hit it out of the park, you're talking hitting 100x as opposed to 5%. So it is a massive windfall, and that should hopefully make up for all those losses you do incur. So I think I think from the private market, the biggest thing is you just need to be able to write large a lot of checks. Average minimum check size in most cases is $25K for most angel type investments. So you're talking that you need $250,000 to $500,000 just to have a chance. Minimum to be able to do anything on the startup world. Now flipping over to the public market side,
and an extra $1 million on top of that to be accredited.
Correct.
So 1.5 million ish to just get started, minimum.
Just because you can take some of that cash. You can start at $1 million and just say take some of that cash and put it into a private investment, and so that would still count towards net worth and still count. But still, yes, it's a lot of money.
Sure.
Now on the public market side. Well, there is a very good reason why there is a day trading limit. I don't know the exact number, but it's somewhere around 90% of day traders they wash out. They will blow up their account, and the biggest issue is that they take on too much risk for what the current position is. They see the ability to triple up their money by buying a Tesla call way out of the money, and there's earnings coming up. That doesn't work out too often. But they will take that risk anyways. And sometimes they get lucky, which is some of the worst things to ever happen. If you're a day trader and you get lucky in the beginning, that's again, probably the worst thing to possibly happen because you take on way more risk than you really need to. But for you to really understand your risk levels of how much risk you're taking on is something that the average person does not know how to do. And so I think that I do think the 25K limit for pattern day trading is a very good thing. There's ways you can get around it. I believe you can do Forex without that minimum. There's a few ways you can get around it, but it is there for a reason. So I do think that in general that having some of these regulations is effective and actually saves a lot of people a lot of money.
Why not just have it based on the types of trades? Like you can't do anything that can get you to zero, or it has to be some percentage of your net worth as opposed to a hard number like that. Because, maybe someone's willing to take 50% of their money off the table just to go and do this because they feel very confident they can do it. Well, fine, but you can't go to zero.
Yeah, I mean, I think a lot of times you do have different margin requirements based off the type of things that you're trading. So if you're trading, if you're doing options, your margin requirements are you have a much, I guess you can't get nearly as much margin versus say a regular common stock. You don't need to have nearly as, you can have a much higher margin. Now, even, look at Robinhood and some of the other ones when you had the Wall Street bets types, that was all coming out. Well, there's certain stocks that had a higher margin requirement because they're inherently more risky. And so they did it at a stock by stock level. And so I think that is actually a very good thing because they are pretty much trying to protect you against yourself. And I think that actually was a very good thing. So that is occurring. It's not very obvious.
Another thing I thought that was kind of interesting was when the Associated Press got compromised, their Twitter page got compromised. They started saying something about some stock, and suddenly that stock just shot through the roof or whatever, and they sold out. That's something that the average investor maybe could weather because they're not going to be focused on this algorithmic, analysis of what the AP is saying in that split second that all went through. Whereas a robot is just going to assume it's correct and go for it. So maybe there's some upside to being just a normal schleb with just a little bit of cash in the bank. And
yeah, computers do, they move fast. So, but the nice thing is they have proper risk controls in place. It's all programmed in. So they don't make nearly as many mistakes as a human does.
So tell me about seek and destroy algorithms. I mean, I've read a bit about them, but they seem like if someone were really, really good at this, they could completely crush everybody else in the market.
Yeah, so seek and destroy algorithms are a way that a lot of hedge funds will go make a little extra money. Pretty much, if you have, say, a major support level, they know that people know there's a support level, and so they said if it goes below this level, I know that's probably going to go down, so I want to get out of the stock. And so what a seek and destroy algorithm does is it quickly does a giant sell order to go take out all those stops. You can see all those orders on what you call it on the book. So you can go see that there's a bunch of people that are below this level that are willing to sell if it or they want to sell if it goes below this level, and they will go and take all of them out and then pop it back up, and then people also get FOMO and they jump right back into that trade, and then but now at a higher price. So that hedge fund is able to make that delta, and so that is a very common technique. You see it, that's done all the time. To the way to get around it, what I do is that you can do and to do some advanced orders. You can pretty much do it based off of a moving average as opposed to a pure stock price move. And so when you see those little blips real quick, it goes down, it goes up, you don't get hit by that. So it actually is much more effective to at least avoid those seek and destroy algorithms.
Mm. But ultimately, you said you wanted to sell at some price point. So
that's a stop. So we're saying is like if it goes, say you have Apple, if Apple goes below $100, you want, okay, I need to get out. I want to sell this because I don't want to take a big loss, which is a very smart thing. You should always have stops on everything.
Yeah.
Never not have stops. But what happens is that the algorithms know that there's a lot of people below that $100. There's very much a psychological level of like the round numbers, and so they know there's a bunch of people below that number that would have stops in place. They can more or less take them all out, get them to go sell, and then they can shoot it back up, and a lot of times people will come back into the market at a worse price and be worse off for it.
Interesting. So the current thing I'm hearing from economists in general is the rental generation, they're just not going to own literally anything. It kind of started with the blockbusters, like you don't own your own videotapes anymore. And now we have Uber. You don't own your own car anymore. And you certainly don't own your house. There's just no way. You can't afford that. I mean, that's truly a pipe dream for most people. Where does the natural conclusion go? I mean, what else can rent seekers own that they don't already own of people's things? I mean, we're literally jeans. You can rent those, rent the rack. I mean, we're really getting to the point where you don't own anything at all.
Yeah, the sharing economy is definitely taken hold. People are way more comfortable with the idea of actually, that they don't actually own something and they let someone else use it. It'll be interesting to see if that trend persists over the long term, or if that's just a short term. Maybe it's one of the things with this current generation in the forward turnings. But it definitely is a theme that we're seeing, and I don't know where it stops. I think we're starting to see what's a WeWork founder.
Yeah.
He's pretty much trying to do the same thing now with single family residences. So like that movement is still going.
I mean, there is something to be said about. I saw one model where it's a house that you technically own this thing, but you can basically pack it and put it on the back of a truck and ship it over to Los Angeles. And now they put it in this kind of stack of these houses. And now you live in Los Angeles, and now you want to start living in San Francisco. You pack up your house and you move it over. And so truly portable living like that does seem to make some sense. You don't own the land. You may own the things inside of it. You may not even own the structure. You certainly don't own the truck that takes you to and fro. But it gives you a lot of autonomy to go wherever you want. But I'm curious kind of how that kind of future, how those people are going to think about things like money, and what do you even do with money? Why do you even really need money? Because other than a handful of dollars to pay your rent and watch your Netflix or whatever, like what are you even doing with it? Why does someone want to be super wealthy in the United States when they basically get all the same things? They can travel anywhere they want, and they can live anywhere they want, they can work anywhere they want. I mean, everything's digital, everything's over Zoom. Why do I care about making $1 million a year versus $50,000 a year?
Yeah, I think what we're seeing in society right now is that a lot of people have stopped trying to follow the path that you're supposed to follow. You graduate high school, you go to college, you go get a career, and you go have 2.5 kids, and like that paradigm is starting to shift, and people are realizing you don't have to follow the typical traditional path. And I love it. I think that's one of those things that this movement's been going on for a while. I mean, really, I first even was made aware of it was when I read the 4 Hour Work Week. I mean, that was mind blowing to even think that you could possibly do that, given that fact that I'd been very traditional up to that point. So I do think that movement is going to continue, and I think it's a great thing to see. I do think that people are going to be you're going to see a lot more fractional ownership. You look at even homes, like there's even like some of the crypto techniques. There's you can start buying fractional shares of homes now, and it's almost like an easier way of doing a timeshare. So I do think that this trend is here.
I have a quick anecdote about that. I was once talking about that book to a friend of mine who's he's kind of already lives that life to some degree, which I thought he'd find it interesting about that book. I'm like, oh, have you ever read the 4 Hour Work Week? He's like, yeah, I just can't see working 2 more hours a week. So they're definitely out there. So you talked a little about the United States being very short-sighted, but I also think companies are very, very short-sighted. Is there a way that we could build a better type of a company, something that just isn't profit driven over the next 3 months and thinks maybe in the 10 years out, let's say, or maybe even just a year out, like, and focused more on really growing a business and what it takes to get the fundamentals right, and focusing on the R&D for the first half of the year instead of just like 2 weeks before they have to start selling whatever's on the back of the truck.
Yeah, I think that's it'd be great. I think that one of the challenges especially with the stock market, if you're a public company, you are quarter to quarter, and to really be able to do something big sometimes, either you have to just be able to handle the pain of having your share price just get crushed, which is not always easy, especially when you're having to report to a board of directors, or else you have to do something like what Dell did, which they go private, and then they go restructure, do what they need to do, and then re-go public. And I think that's typically what we're seeing. There are companies out there that are trying to take a much more long-term type view, and the problem is that they a lot of times they are getting penalized for it, and which is unfortunate. I think the whole idea is I think Warren Buffett is doing very well with Berkshire Hathaway, where he pretty much says, he pretty much tries getting only people that are going to hold the stock for the long term. And I think that he's done a very effective job with that. And he pretty much says that he does not care about quarter to quarter. You almost have to have that as part of your culture if you're going to really be able to do that well. And I don't think that's something that many founders or CEOs are willing to go do, just because it is very difficult.
Especially because they're bonused on quarterly earnings for the most part. They're not, or stock movement or something like that, which is, it's an ugly loop. It basically means you're stuck in this hell of trying to make sure your quarterly profits are getting up, which is good for shareholders, but terrible for the business.
Yeah, I think a lot of CEOs are professional CEOs. They were not founders. So that, I think the major difference I've seen is the people that have been founders and ran a public company, they do have a longer term view. Where professional CEOs that just come in, they are pretty much making most of the economics through bonuses. I think that's where you see a lot of the detriment.
I've been saying this for a while, and I'd love to hear whether you agree with this or not. So the human body, I think, is very similar to a company in the sense that we have genetics and we have epigenetics. So genetics would be sort of your operating agreement when you're starting the company, your shareholders agreement with the 2 or 3 founders, co-founders, or whatever, maybe some employment docs or whatever to get started. And that's about it. That's, your LLC documents with the state, it's like 5 or 6 things that have to get done for any like real company. But as soon as you start taking on additional things like contracts with vendors, contracts with customers, contracts with new employees, contracts with the state, or something that you have to do above and beyond what you're normally asked to do, or God forbid if you go public, you are now taking on the epigenetics. This is very similar to like a virus or something. Like your body just got reprogrammed. Like you didn't necessarily want it to go this way, or maybe you were okay with it at the time and you thought it would be great to do this, but whatever, your body now is doing something different than it was originally designed to do. And to me, people don't spend enough time thinking about what this thing, this code that they're injecting into their body, this code that they're injecting in their company in this case, is going to do for the company. Like, what incentives are suddenly get changed? And there's a bunch of different examples of this. Like for instance, let's say you have insurance, right? What are you supposed to do? Are you supposed to get worse at everything? So now because your insurance is going to pay for the downside? Is that really what we're saying? Well, no, because the insurance isn't going to give you the money if you keep screwing up. They'll give you the money once, because accidents happen, but they're not going to keep reinsuring you year after year if you're constantly a liability for them. So what are you supposed to do now? Well, now you're supposed to not trigger your insurance. You're supposed to do everything right is what you're supposed to do. So insurance basically is just a way to punish yourself so you do the right thing, and the occasional downside of you not doing the right thing. And these are the kinds of little pieces of code that get injected in companies. Some of them are good and some of them are terrible. I've seen a lot of agreements with employees that are just terrible agreements. You're basically just adding a bunch of liabilities to this company, not assets, true liabilities to the company. So like, how do you get from an IPO being this hugely detrimental thing to being potentially a positive thing for the company beyond just the short-term financial windfall?
Yeah, I think there's a lot of benefits being a public company. You have more access to capital. You have more liquidity. So even like we talk about the DCF models of valuing a company, when you have more liquidity, the discount rate is reduced. So your value of your company goes up. So there's a lot of benefits to that for shareholders. So but those benefits you have to now weigh against the downside of that, which is you have to report quarterly earnings. You have complete visibility of everyone of what you're doing. You have to, your competition can see what you're doing, and actually know your numbers. It is a difficult thing to balance, and I think a lot of companies have to decide what is the direction they want to go. I think ultimately a lot of founders, a lot of their investors ultimately want to see an IPO because that's their big liquidity event. That is like the ultimate. That is the goal. And so I think if you don't want to have that as the goal, when you set up a company, you need to be finding investors that are okay with not having that massive liquidity event. Maybe okay having a company into perpetuity and living off of dividends. So it's almost an agreement that you need to make with your investors from the get-go. If you don't, then you're pretty much going to be beholden to them and having those liquidity events down the road.
So you think that there's a way to do it, sort of maybe like a B Corp, a new type of corporation or something where you just like, this is not necessarily a for good company, but this is a for the good of the investors company.
I think yes, for sure. I mean, there's some companies that have the ESG distinction, or they say they're ESG. Investors inherently know that if you're an ESG company, that you're not going to be for profit in all cases. And there's a lot of debate if that's a good thing or a bad thing. But I think that a lot of people do want to have people doing the right thing for society and actually trying to protect the environment and also being good stewards, good citizens within the country as well. And so I think as an investor, you have to decide, where do you fall? Are you a pure capitalist, or are you also trying to maybe make some money, but with a little bit less, but also do good? And I think, but at the end of the day, it really comes down to making sure you pick those right investors from day one.
So, I mean, the idea of the market being driven by capitalism is an interesting one, but I'm not sure it's right anymore. Like once upon a time, we used to say, if you're investing in a company, especially a stock, right, you're giving the common man and every person who just happens to have a little money in their pocket the ability to share in the upside of a company they had some belief in. But now it seems like everything's driven by volatility. You really have very few people investing in companies because they believe in the fundamentals, and you have a lot more people investing in whether they think it's going to go up or down today. And that's moving away from capitalism and more towards the sport of watching this ping-ponging back and forth, which is incredibly interesting, but also not what I typically call capitalism, where you're seeing this upside related to building something.
Yeah, I think that is a challenge right now, that you are seeing that people they care more about the price action as opposed to the fundamentals. And that absolutely does occur. And I think in the short term, the market is a voting mechanism that decides, is it going to go up or going down? However, over the long term, the intrinsic value will come out. And so it really depends the type of investor. Are you an investor where you're looking for that long term, which you're going after the fundamentals? You're looking at what the current economic conditions are, and is this going to improve and cause this company to succeed? Or are you looking at it from just trying to capture a small move in the company and make a buck? Now it's interesting. I like being in venture capital. I see both sides. I'm a day trader, but I'm also in venture capital. Mm-hmm. So in venture capital, there's very much fundamental belief that it has to be fundamentals that are actually going to drive this, because there is in the private market, there's no short-term trade. You're putting your money in and it's gone until they actually have a liquidity event of some sort. And where on the public market, well, the liquidity has a downside that you can get in and out real quick. And so you don't have to have nearly as much conviction behind a company. Now there's long-term capital gains. There's reasons why you might want to hold it longer, because there are some tax benefits to it. But ultimately, it's just a different mindset of what you're looking at. And so I think over the long term, a private investment is a much better one, just because you are forced to take the long-term view. There's really three ways of getting alpha as an investor. You either have to have an information advantage, so you can something about inside information that the average person doesn't know. You can't do that legally in the public market. However, on the private market, you can do it all day long. You have to have the other option is having analytical advantage. So you have that same data, but you're just better at analyzing to know if this is actually a good thing or a bad thing. Now you can do that in both the private market, although it's a little bit more difficult. But you also can do it very much so in the public market. But there's a lot of really good people, a lot of smart computers, a lot of money there thrown at to analyze it more effectively. The third thing is having a behavioral advantage. So you don't get FOMO, you don't get fear of missing out. You don't see a massive drawdown and panic and sell. Now, the private market has a big advantage that you're just inherently you remove that behavioral component, because as long as you don't have FOMO when you first get in, that's the only thing you have to worry about. Once you're in, and there's nothing you can do from a behavioral standpoint. It's out of your hands. You've effectively removed yourself from that equation. Maybe you can do some activist things, but really there's not a whole lot. On the public market, though, I can tell you what, animal spirits are a real thing. Humans are irrational. Mm-hmm. They will go and sell, when they shouldn't. They should go, and they'll go buy when they shouldn't. And it is just, they almost inherently do the wrong thing, because that's just human nature. That's
interesting. Yeah. So the whole buy low, sell high thing, people will think that they're doing that, and then they actually get in there and they get freaked out. They're too excited.
Yeah, one thing that's always interesting, people are very successful when they're paper trading, when they have no emotion about it because it's not real money. And then as soon as they actually flip over to real money, they fall apart. And this happens over and over again.
Wow. That's kind of scary.
Well, it's interesting. One of the things that I think about is I know that I'm human. I have that bias. One of the things I try doing is I have this hybrid model where I mix both human element of it, me making a decision about where things are going to go, but then I have a computer that helps me go manage the trade. And so once I go do the order, say I'm going to buy Apple, it flips over to my program that goes and runs and manages the trade for me. So I remove the human component to it, that behavioral component, and let the computer, which just looks at the cold hard numbers, is this a good trade still, or do I need to exit it? And I found that using that technique has been definitely much more successful.
Mm-hmm. As long as the stock doesn't go to zero, there's no reason you can't hold on to it forever too. You can just wait it out because stocks generally do rebound.
They do, but look at 2001. How many stocks never came back, or even
as long as it doesn't go to zero.
I think even there's so many stocks out there that have had 90% drawdowns, and they're unlikely, unless you hold it for 100 years, that they're ever going to get back up to that point. So I do agree with that in a normal market condition, but there are times when that does not hold true.
Interesting. Is there any other gotchas that people should be aware of?
Oh, there's so many.
I mean, kind of like that. Well, like there's really kind of fun ones. Like in certain places, like trading doesn't happen that day or whatever. So your algorithm's set up to do something very specific on a specific day, but the market's closed. You literally cannot do that thing.
Yeah. I mean, there's lots of things out there. We can go on for hours on this one, but
all right, I'll leave it at that. So can you tell us about SPACs? There's been a lot in the news about it, new sort of way to go public very quickly. Can you?
Yeah, SPACs actually existed quite a bit, even 10, 15 years ago, maybe a little bit longer. And they were very, very popular back then. Now they just started coming back in vogue during like 2020, 2021. There are a lot of benefits to it for the company, the target company. But there's usually not a whole lot of benefit for you to go as an investor or trader to go put money into that SPAC. Unless you're one of the few that actually go and they get in very, very early and they just pretty much say the money's going to sit here, and either you're going to make money. You can't lose money because either you're going to get a target company, and then you choose if you want to go do that target company, or you get money back plus some interest. I think we're definitely seeing SPACs come down. I'd say 99% of people don't understand how a SPAC actually works. And even, truth be told, I couldn't tell you all the details of how a SPAC works either. But I know that it's probably better to steer clear of them as a trader investor, unless you're going to be putting money in initially.
Interesting. It's the way I've been effectively told that it works is more or less just there's a company and let's say you have a $100 million idea and their SPAC is worth $10 million. You're basically buying their $10 million from them of their value of the company. And if the stock goes up by $100 million because you're adding $100 million, it's no big deal. It's just $10 million off of that additional raise. So now you're left with $90 million plus whatever the original company is worth, which it's nothing. It's just an IPO shell. And now you have $90 million to go walk around and build your company with.
Yeah, it is a way for companies to go public sooner and actually have some increased cash on hand. So there are definitely some benefits if you're the target company. There's so many SPACs that pretty much didn't have a target company, and they or pretty much either had I think Donald Trump, he lost his SPAC because they couldn't find a target company, and he had to return all the capital. So a lot of them don't want to do that because there's a whole lot of work to get it set up. And if you can't find a target company, then you're effectively, all that goes away. And so a lot of times they take deals that are probably less than ideal because they're running out of time.
So how does that, I mean, I know that there's a very big expense associated with going IPO. Like it's $1 million plus about a year's worth of work with, people sitting in your office constantly over your shoulder, looking at every single thing. Like what does it typically take for a company to use a SPAC to take their company?
It's still a big endeavor. Like it's not the same level of an IPO. You don't have to do as many road shows. but you are still having to go through the whole process, and it is a daunting process. It takes. I know a number of companies that it's taken at least 6 months to go do. But it is a bit simpler. It's a bit easier, just because you don't have to do a lot of that work. But it's not like just a golden bullet. You can just kind of, just go do that and you can, circumvent all the tough things about an IPO.
Somewhat easy, but not easy.
Yeah.
There's certain companies I've run across that, I just felt like they should probably go public, but them getting $1 million and spending a whole year doing it is probably unlikely that they would be able to cross that bridge.
Yeah, most companies need to get into multi-billion-dollar type range before it's even worth it from just an overhead point of view to actually go do. And that's one of the challenges is how do you make companies able to go public earlier? And I think that's one of the challenges. If you just look at the private market versus public market, the public market. Like if you look at a lot of the value creation historically occurred when a company went public. So looking at like Google or Facebook, when they went public, they're relatively low market cap. Most of the value creation occurred while they were public. However, because the bar has gone so high for a lot of these companies to go public, a lot of these companies are staying private longer. But what's happening is that all the value creation for those companies is occurring while it's private, which locks out, as you mentioned earlier, locks out anyone unless you're an accredited investor from it. So there needs to be some way for companies to go public sooner with a lower overhead. It costs companies somewhere around $3 million to maintain compliance from a regulatory standpoint.
Per year?
Per year.
Wow.
And for New York Stock Exchange, for instance. And so if you're a $100 million top line company, that's a huge chunk of it. So it's just not reasonable unless you're into that unicorn type range to go public.
Gotcha. So we've been hearing a lot in the news about the rate of employment. What do you think the true rate of employment is, or how is that measured today, and how should it be measured?
Great question. I don't know. There's a quick answer. I think going back to the inflation question a little bit earlier, I do think that we are seeing we don't have as not as nebulous as it was before. I think we do have a chance of actually having a soft landing, which is I would never have actually thought early days. The traditional definition of a soft landing is fighting inflation, reducing inflation, but not increasing unemployment. I think a more accurate way of thinking about it for me at least, is that you want to see the job openings come down, but maintain steady unemployment numbers. And that's what we're kind of seeing today. So I do think I think a lot of that is the true number is coming down. I can anecdotally I can see like a lot of companies that had big hiring plans from technology perspective are all freezing, and they're up, not retracting. Taking a lot of those job postings off their websites. So it is definitely coming down. I couldn't tell you exactly where it is. I think. I do think that it is. It's reasonably accurate, though.
So there was one comment I saw that basically the amount of people who are employed is a useful metric, but the amount of people who are not employed actually accounts for two totally large different group of people. One is people who are looking but can't find. Another group is people who aren't even looking.
They've given up.
They totally given up from the whole thing. But that first group is a fairly distinct group, that those people are actively sending resumes or trying to go to job interviews, or at least would say they are, even if they're not doing a good job of it. But the way the U.S. government tracks that is they say, well, if they haven't had a job within the last 3 months, they fall into that second bucket where they're not even looking. But that's actually not true. That just means that they just still haven't found a job.
The unemployment benefits have run out.
Right. So it seems like the true unemployment rate is probably wildly miscalculated as far as, the people who want a job and just simply can't, for whatever reason, can't figure out how to get one, compared to people who just ran out of unemployment benefits.
Yeah, I think a lot of them, again, anecdotal, but I've seen quite a few people go to gig working, and they are technically unemployed still. They have no W-2 income, yet they are generating 1099 income. And so I do think that what people are just inherently at some point, if they can't get a job after 3 months, they're going to be going to Uber. They're going to go run, Postmate deliveries, or, so that they're going to take, a different way of actually generating income. And so I do think that they are getting somewhat employed. They at least have some income coming in. Just might not be a true W-2 type income.
Interesting. So 2 quotes I wanted to read to you, which I'm sure you've probably read both of them. Treasury Secretary Janet Yellen admitted that she was, quote, wrong about the path that inflation would take. And German Vice Chancellor Robert Habeck said, because we didn't know, to be honest, and nobody knew how this gas market is intertwined, meaning with the entirety of the market. So first of all, were those things, do you think investors knew well? That inflation was heavily tied and gas was heavily intertwined.
Yeah, I mean, it was very well known that inflation was not transitory, and I think I don't know as much about the gas side, but it was very. I don't think anyone had any preconceived notions that things are way worse than what the Fed was letting on. So
if that's the case, where you feel like your cohort of traders knew this fairly well, and this was common knowledge, which I think it was. I mean, I feel like I knew this information, and I'm not at all what you are. How did we end up with these people in these jobs? I mean, this isn't like just a random pattern day trader who just had a couple bucks to throw at some bad ideas. These are the heads of the monetary systems for 2 major countries in the Western Hemisphere. These people sound like idiots. They sound like they have nobody who's informing them of what's really going on out there, and they're just throwing darts at the wall. How did this happen? I mean, shouldn't there be some sort of stopgap? Shouldn't they have some sort of cabinet made of actual professionals who can tell them that this is what's going to happen?
Yeah, I think they did know. I think that inflation is a self-fulfilling prophecy. So they pretty much had to maintain a script to, that inflation was not occurring. I do think one of the reasons how a lot of them have got elected is that we don't get the best and the best actually going into the public sector. They're not going to be, they're not going to, hold an office or be in the cabinet. They are pretty much going to be making money. If they're any good at all, they're going to be out there on the private side, and making money. And so we don't get the best and brightest. The people that do, unfortunately, I take a step back. People are motivated by a few different things. It's either family, it's power, or it's money. And unfortunately, for mostly the political side, it's they are more focused on power as opposed to money. And the people that really, really understand the space well and very, very competent are more focused on monies. And so they're going to stay private and not be a public official.
And they would probably avoid it if they were even offered the position.
I know I would.
Yeah. That's terrifying. Another version of that same thing is I once heard that once upon a time, the best and the brightest went to politics. Then they went to Wall Street, and now they're in ads. And so what are you left with in politics? You got the C team, And by those 2 comments alone, as far as financial, fiscal understanding, either they're singing a song unrelated to how they actually feel and how they think, or which I kind of hope is true. I kind of hope they're lying, or they really don't know what they're doing. Either way, I kind of don't want them in charge. That's kind of scary. But so how does the average young budding capitalist get rich? What would you do if you were talking to a 20-something who, just got their first job and you wanted to, by the time they're retirement age, they're famously wealthy?
Yeah, so I guess define rich. All right, so there's kind of 3 ways of thinking about this.
Over $100 million.
Over $100 million. I'll give the quick, depending where you want to end up in your career.
Sure.
If you want to make, have a pretty good likelihood of success, you need to be diversified, or you need to be something that is going to have a high likelihood of outcome. So if more people have become millionaires off of real estate versus anywhere else. So if you're just trying to get into like the low millionaire type status, go into real estate. If you're wanting to get in the, call it 50 to really about 50 million to maybe 100 million, if you're lucky, that's probably better to be an investor. It's just you you have a diversified portfolio. You don't you're broad and you're gonna do well over time. To becoming like richer, super rich, billionaire type status, you need concentration, and to do that, you need to have founded a company. It is very, very few individuals that have ever gone to a billionaire status investing. Almost everyone that's ever gone to a billionaire status has done it through founding a company, and had that concentration to get them to that level. So, but the problem with that is that most companies fail. Mm-hmm. So that you're taking a lot of risk on, and to go do that. And if it works out, you'll be filthy rich, but there's a good chance that you end up with nothing or very, very little. Mm-hmm. So I think it just depends on where you want to be in that spectrum. And again, also now if you're looking at private versus public, I would probably focus on private initially, just be given I think most of value creation and wealth generation occurs on the private side today. That might not always be the case, especially as you see companies starting to tokenize themselves. They might be able to go public sooner, but at least today it is done. It's you need to be on the private side, because that's where most of the generation of wealth does occur.
I have heard some very crazy stories about the real estate market where people will buy up, some set of hotel blocks in some kind of semi-third world country, not exactly third world, but, certainly not, downtown LA or something. And they will just befriend all the politicians and, pay off whatever it takes. And then suddenly laws get passed that make it impossible for anyone else to create those things. So now they have a monopoly of those apartment blocks, and then they'll set up a resort with some friends. Maybe they don't even fund the resort. They just tell their friends, hey, as long as you basically put your thing here, I'll give you these tax breaks with the local authorities. And suddenly this thing that was maybe this minor investment overall is worth, 50, 100, 1,000x what it was originally worth, just because there's nothing left. This is all the land you're going to have. Mm-hmm. So there might be some other kind of clever ways that people could get to the hyper wealthy.
There's always all kinds of clever tricks out there to do it. I mean, there's a million ways to get very, very rich. The problem is finding the right one. Mm-hmm. And a lot of it also you have to kind of look to see what is your actual demeanor, your style, that's going to be a good fit for you. Are you more conservative by nature? Then maybe you have a more diversified portfolio type approach. Are you more aggressive? Then maybe you go all in on one company. Maybe you're just very clever and you find one of those loopholes that allows you to scale very, very quickly your real estate empire. Mm-hmm. I think it's the challenge is figuring out the right way for you.
So you also mentioned Powell and the transitory nature. I think that there is something to understanding the bellweathers, understanding where things are going. If you can see that what inflation really looks like, and you can sort of hedge against these things. So where do people go to find out about these kinds of things and get better at investing? Like if you were to give a hit list of things that you would say, you've got to go read these things on a regular basis, because this is where the real knowledge is coming from. These are the real economists who seem to know what they're talking about.
Yeah, that's always there's a lot of noise out there, and trying to hone in onto the ones that actually have signal. I think I spend half my time looking at just trying to figure out what actually has signal. So I have systems set up in place just so I can start sifting through what's actually a good Twitter account, for instance, versus not a good Twitter account, which actually is getting value, actually improving my actual returns, my equity curve, versus who's not. And so that is a very iterative type process, and it changes over time. I think if you're looking for higher level, I do think like the ISM or the manufacturers index is a great way of kind of starting and understanding and where the manufacturing is going, because that is a really good precursor to where the S&P is going over the next 6 months. Mm-hmm. If it's above 50, there's a good chance the S&P is going to be up, up higher than it is today. So there are these places that you can, techniques that you can look at. I think a lot of it is really just first starting to understand macro and then kind of, and just having an idea like what levers go pull, like what happens to the value of the dollar if interest rates goes up or inflation goes up. Just understanding how all those levers pull. I think probably the best source for a lot of this to understand it. I do love Ray Dalio did this amazing thing called the Economic Machine, which is this video that just shows how the economy works. It's like a 30-minute video, but it's really, really well done. That gives you a nice overview, and then you need to start honing in on those specific aspects of that, that you see in that video, and you'll get a much better, clearer picture of kind of where things might be going.
So what do you think? Is it going to go up? Is it going to go down? What do you think the economy is going to look like in another 6 months, a year?
It's a great question. I first off, I don't know.
No one knows, but
I'll assign percentages. I give the edge to that we are that the stock market is higher in 6 months than it is today.
Interesting.
I do think there's a very good chance that we have reached a near-term bottom. I do think that whenever you start seeing news come out that's negative, and yet the market goes up, that's usually a pretty good sign that we're getting close to a bottom. Now, the bottom in the market is market's inherently a discounting mechanism. So they're looking at where they think that the rates are where everything's going to be in 6 months. Actual economy is going to be in 6 months. So the economy might still dip for the next 6 months. But if the market thinks it's going to be better, after that fact, that's why the prices might be going up. It's always interesting to look at the market. The stock market is about 6 months ahead on the real estate. So if you look at like a REIT, it's about see where that actual price of that REIT is going. That's about 6 month precursor to what actually is going to happen in the actual real estate market. And you see this kind of across the board.
Any other kind of big signals that you pay attention to?
Yeah, I follow the semiconductors. Semiconductors are the lifeblood of technology today. So that is like the core component that where everything goes. So I heavily follow the semis and what direction they're going to see where NASDAQ's going to go. I think that's a very good precursor.
Interesting. All right. Well, this has been great. So how do people find you, and how do they get in touch with you? And
I don't use it much, but I'm on Twitter, just my last name, Moilanen, or LinkedIn. I don't have a ton of socials.
Well, hopefully people will reach out to you. You're definitely one of the smartest guys I've met in this space. So I want to thank you for joining me on this episode of the RSnake Show.
Absolutely. Thanks for having me.
Yeah. Thanks for coming.